Recording.
Welcome back to the Best of Investing. I'm Edward Brown, your host, along with my co-host Mark Hanf of Pacific Private Money. And when we went to the first commercial break, we asked this first trivia question. Dueling Banjos was the theme song to what 1972 movie starring Burt Reynolds? Mark.
I didn't see the movie, but I know it's Deliverance.
Deliverance, that's right. Okay, we are in this.
Tune.
Yeah, it is. I love that tune. That's a one-hit wonder, by the way.
Mm-hmm.
We are in the studio with Mike Zaidlin of Madrone Retirement Investors, and Mike's got an interesting approach to being an investment advisor because he does not charge a percentage of assets of fees, and that's going to bring me right to my question, which is, why are you here then? What do you do as an investment advisor if you don't charge a percentage of assets of fees? How do you get paid?
Well, there are a couple approaches. One is most advisors charge a fee. They charge, as I said before, anywhere from 1.5%, maybe down to 1% or so. The problem is that it's very difficult, I believe, to justify that on a per hour or time basis. And I also think that it does a lot of harm to investors' ability to meet their overall investing goals. Basically, the Department of Labor has estimated that each percentage in costs reduces an investor's overall funds after 20 years by about 20%, which pretty much means that if for every 0.25% in fees, wherever they are being paid, whether they're being paid to the mutual fund manager or to the investment advisor, each 0.25% in fees has the potential to postpone your retirement by 1 year. And that estimate has been made by a number of advisors.
So if that's a 0.25%. So if you charge 2%, that's 8 years off of your retirement. That's pretty significant.
Well, that's somewhat theoretical as well,
Yeah,
insofar as it's
but money is money. So whether you pay it to the mutual fund or the advisor, it's still coming out of your account.
But in fairness to some advisors who say they can outperform the market, or mutual fund managers who are actively managed mutual fund managers, they would come back and say, well, I can compensate for that by providing superior performance.
Right. I mean, isn't an advisor who charges on a percentage, aren't they going to be more aligned with the client's goals and do a better job for them?
Well, that's an interesting question, Mark, because you have to ask yourself, in what other profession do we even use the term aligned? If I go to my accountant to do my taxes, my accountant doesn't say to me, Mike, I am willing to do this for a flat fee that basically represents how much time I'm putting in, but if you pay me a percentage of what you made this year, I will do more research into the tax code. I will do a better job for you.
Which is actually, if I remember correctly, is against the law. CPAs can't charge a percentage of refund. Yeah.
Or if I go to an estate planning attorney to do my estate plan, my estate planning attorney will more or less charge me a fee based on his or her time and not on a percentage of whatever my net worth is.
But in theory, if I understand it correctly, the typical investment advisor who charges a percentage of asset fee, isn't that person supposed to be monitoring the account during the year? So it's not just a one-time shot of investing the funds, but it's watching it as time goes on, things change, but then we get into the market timing also. But
well, to answer your question, yes, the investment advisor typically observes and monitors and answers the questions and provides investment advice throughout the year or financial advice throughout the year. The flat fee can include that, and it should include that. Either way, the question comes down to, even taking into account that it's an ongoing process, how much time goes into this? So, for example, let's say an investor has $500,000. Typically, an investment advisor or broker with an advisory fee or a wrap fee would charge, let's say, 1.25%. So that would be about $6,000 a year. Now, the question then becomes how much time is, in my mind, the question becomes how much time is going into this. I believe that managing an account of that size and providing all the necessary other services, advising the client on questions regarding tax harvesting or Roth IRAs or 401k contributions, or whether to set up 529 plans, and if so, in which 529 plan, and which all the things that an investment advisor does or should do, take up an estimated amount of time. And an estate planning attorney or a CPA, they have a pretty good idea of how much time something's going to take, and so does an investment advisor. And I frankly don't believe that the fees that on a percentage basis come anywhere near what I think would be a fair level of compensation based on the time an advisor should
Well,
put
because in
in.
theory, if someone has 500,000 or 900,000, potentially it would be the same amount of time spent.
It would be pretty close. My fees are probably assuming another 2 hours for that difference between 500,000 and 900,000, because generally the issues are going to be the same. So to me, the fees, once you start getting into whole percentages, 1% or more, you're severely cutting into your client's retirement savings, basically, and it's going to be very difficult unless you're that extremely rare advisor or mutual fund manager who can compensate by providing superior service. I believe that most advisors should simply provide a service which reflects the fact that they are unlikely to outperform the market and therefore compensate for those high fees.
Okay, I'm going to put you on the hot seat for just a minute here. Is it really as simple as just using low-cost index funds? Because if it is, then how would you make a living, right? I mean, why would theoretically someone come to you and say, gee, you just gave me advice about buying low-cost mutual funds. Thank you very much. I don't need an advisor. So where do you come in on something like that?
Well, that's a great question. Is it as simple as just saying, oh, okay, put 20% in U.S. large caps, put 20% in European small caps, put 20% in U.S. treasuries? It's not that simple. First of all, each client is going to have a different allocation depending on, one, what their total net worth is, what their risk tolerance is, whether they have money in other accounts, or whether they're going to inherit something. So let me give you an example. 10 years ago, if someone had come to me and said, I would like an allocation, I'd like you to do my investment advisory, I would have put together a portfolio that may not have included an index fund in emerging markets, or actually 20 years ago, would not have included an index fund in emerging markets because there were no emerging markets. They were still largely they were still not developing economies yet. They were, in the case of China, still under communist rule. In the case of India, still sort of in a socialist mode without a stock market, basically. And so if you took that and said, great, I've got my index fund allocation, you would have missed probably the highest returns you would have gotten out of every index fund that you could have, because that's where the greatest returns were in emerging markets over the last 10 or 15 years. So it's something that needs to be monitored. Gold. Should gold be in your portfolio? Maybe. It just depends on a number of factors. So whatever portfolio is put together is just good for that for a while, more than likely. In addition, advisors, I provide a lot of information to my clients about, for example, let's take Roth contributions. In an IRA, you can only contribute $5,000 or $6,000 if you're over 50. In a 401k, if your 401k plan has a feature which allows for a Roth 401k contribution, you can contribute $16,500. Should you contribute to your Roth 401k, or should you just make a regular contribution? It depends. One advantage is obviously you have the higher contribution limits in a 401k. In addition, here's another factor regarding Roths. If you have a Roth IRA, you don't have to make a minimum required distribution when you turn 70 and a half. In a 401k, you do, if you have a 401k Roth plan. However, you can obviate that by rolling it over into your regular Roth IRA. Those are things that you're not probably going to know.
So among the points, so among the points is that it's a lot more complex than just saying, I can just pick an index fund, I don't need your help for that. It's more a balancing act. And in this market with all of the news about how poorly, for example, the Dow Jones index has done, someone like yourself can contribute a lot of value add.
Well, I like to think so, yeah.
Well, Mike, stick around with us. We got a few more questions for you. Then we're going to get into Mark with email time, what's going on in real estate. We've been in the studio here with Mike Zaidlin from the Drone Investors. And when we get back, also, we're going to want your information to give out to people, because I'm sure there's going to be a lot of people who are going to want to find out how they can save money on their investment advisors' fees. Okay, here's our second trivia question. From what movie did Celine Dion sing "My Heart Will Go On" in a 1997 movie starring Leonardo DiCaprio and Kate Winslet? The first three callers, remember, we're talking about movie themes with water. The first three callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Again, their website is lighthouse4fun.com. Call 888-912-1190. That's 888-912-1190 to answer this question. From what movie did Celine Dion sing My Heart Will Go On in a 1997 movie starring Leonardo DiCaprio and Kate Winslet? Again, call 888-912-1190 and make sure to include your name, address, email address, and phone number, and we'll be right back.